Okay, let's unpack this. Today, we're taking a deep dive into source material you've shared with us, specifically focusing on insights from a FinCrime intelligence article.
Hmm.
Our mission, to really get into what front-running is, how it works, why it's such a serious problem in financial markets, and what's being done about it, all based on the details in this piece.
Right.
And right up front, the source makes clear this practice isn't just like frowned upon, it's illegal,
Yeah,
carries some pretty heavy consequences.
absolutely. And what's fascinating here, I think, is how this practice, fundamentally, it's about the erosion of trust in the financial systems themselves.
Okay.
Understanding front running is really key to grasping market integrity or, where it can break down and the subtle, sometimes hidden ways confidence gets undermined in trading.
So the source dives right in, defining it. How does it frame what front-running actually is?
Well, it defines it as an unethical practice where a financial professional or maybe an insider executes orders on a security for their own benefit.
Huh.
And they do this using advanced knowledge of pending customer orders that haven't happened yet.
Right. So a big client is about to make a trade, one that's probably going to move the price.
Exactly.
And you jump in and trade for yourself before their order goes through. And the goal there is simply to profit from that expected move.
That's precisely it. You're trying to get ahead of the predictable price impact of that large customer order.
Which, as the source points out again and again, is exactly why it's illegal. It violates securities regulations.
Hmm.
The core problem, as the article really highlights, is it unfairly disadvantages the customers. The very people whose orders are causing the price change in the first place.
And it just fundamentally undermines market integrity.
Yeah, it feels like cutting in line, but, with potentially huge financial consequences.
It does feel like that, but it's often far more sophisticated and damaging than just simple line cutting. And the source gets into how this actually plays out. It's not always just one simple trade.
Okay, so how does front-running occur in practice, according to the article? What are the mechanisms they talk about?
Well, the typical scenario involves someone like a broker or a trader or maybe another insider acting on that advanced knowledge of a client's order that's likely to influence the price.
Right.
But the source details several specific methods, which kind of shows its complexity.
Okay, like what? What are some of those methods?
It can be as direct as placing a personal order or maybe the firm's own proprietary order just before executing a large client order. Very direct.
Okay.
But it can also involve using, say, high-frequency trading algorithms. These can detect patterns or signals of incoming large trades, sometimes called block trades.
Ah, okay, so using speed and tech to essentially see the big orders being lined up before others can react.
Exactly. Speed is the edge there. Another method mentioned is accessing order flow data, or what are called indications of interest, IOIs. Indications of interest, basically signals of potential trading interest. Getting that ahead of the public market or ahead of clients who don't have that same privileged view.
Got it.
The article also mentions trading ahead of, say, your own firm's research publications or maybe corporate announcements based on non-public insight you gained internally.
Wow, that last one feels particularly, I don't know, insidious. Trading on insight from your own firm's research before the public even sees it.
It's a clear conflict of interest.
And the source is clear, this isn't just a problem for, like, the stock market, right? It's broader.
Oh, yeah. The article really stresses this misconduct can happen in both traditional and electronic trading environments. It's not just one or the other.
Okay.
And it's found across a whole range of markets. Equities, fixed income, commodities, derivatives, even crypto markets are mentioned specifically. It's a
Yeah.
broad issue.
Wow. Covering that whole spectrum really shows how pervasive the potential for this abuse is. The source also breaks it down into distinct types of front-running. Can you walk us through those?
Sure. The article identifies three main forms. First, there's order-based front-running. This is kind of the classic type we've been discussing.
Right.
A trader sees a large client buy or sell order coming in and executes their own trade before placing the client's order.
So if it's a big buy order, they buy low just before, knowing the client's order will likely push the price up.
Exactly.
Then they execute the client's order at that now higher price, and they've pocketed a quick profit on their own earlier trade.
That's the mechanism. The second type is information-based front-running. This is a bit different. Here, a trader gets some kind of confidential information. Maybe from a research analyst inside the firm, maybe from a client meeting, maybe some other non-public source, and uses that information to trade ahead of the market before that info gets out.
like knowing a really positive earnings report is about to drop and
Yeah.
buying shares based purely on that non-public knowledge.
Precisely that, yeah. Then the third type mentioned is electronic or latency arbitrage front running. This one's more technical, really tied to high-speed trading. High-speed traders detect tiny delays, like microsecond delays, or inefficiencies between different execution systems or platforms.
Right. The plumbing of the market.
Exactly. And they use that knowledge of the delay to profit from tiny price movements that happen before other orders can fully process across all those different venues.
Exploiting microseconds of delay. Wow, that really highlights the sophistication involved today. And the source just keeps hammering home that no matter the method, no matter the type, it's illegal. It's a serious breach of market integrity.
It absolutely does. And the regulatory response globally really reflects how serious it's taken. The source states pretty clearly that front running is, well, universally recognized as a form of market abuse.
Yeah, the article lists regulations from all over the EU, US, UK, India, Australia, Singapore. It seems like this isn't just a regional rule. Is there a common principle the source highlights across all these different laws?
Well, while the specific wording might vary, the underlying principle that comes through in the source is definitely the prohibition on using non-public material information.
Material, meaning it could affect the price.
Right. Information derived from your position or your client relationships and using that to get an unfair trading advantage. They mention key examples like the EU's Market Abuse Regulation, or MAR,
Okay.
the U.S. Securities Exchange Act of 1934, and specific FinNR rules, the U.K.'s Financial Services and Markets Act, and similar rules in places like India with SEBI, Australia's ASIC, and Singapore. It's global.
And how do regulators typically treat this kind of violation? Is it just a slap on the wrist?
No, no. The article says regulators treat front running as either a criminal or a civil offense, depending on the place and, how bad it was.
And the penalties are substantial, I assume, not just a warning.
Far from it. The source details some really significant potential penalties. We're talking hefty fines, both for the individuals and their firms.
Right.
Trading bans, license revocations, which can obviously end someone's career in finance.
Yeah, completely.
And in the really severe cases, criminal prosecution and even imprisonment. The insight there, I think, is that the penalties often aim not just to punish, but to actually remove the bad actor from the market entirely. It underscores how critical trust is.
Hmm.
And beyond all the legal stuff, there's also severe reputational damage that can destroy client relationships, potentially lead to the failure of the whole business.
So it hits you financially, professionally, reputationally, and potentially personally with jail time. The source also mentions it's becoming maybe harder to get away with now.
Yes, they do note that. Enhancements in trade surveillance technology, a stronger regulatory focus, and also things like whistleblower protections. All these have increased the likelihood that these practices get detected and enforced globally.
Okay, that leads us nicely into detection.
Yeah.
How do firms and regulators actually spot this kind of complex behavior? What are the key red flags the source points to?
Well, detecting front running needs some pretty sophisticated monitoring. You're looking at trading behavior, the sequence of orders, who had access to what confidential information, and when.
Right.
The specific red flags the source mentions are things like trades being executed immediately before large client orders, especially orders that you'd expect to move the market.
Like clockwork, right.
Yeah.
Trade pops up just nanoseconds before the big one hits.
Exactly like clockwork. Another key indicator is if a particular trader consistently gets unusually favorable prices compared to how their clients' orders for the same security are executed around the same time.
Hmm. They always seem to get the absolute best price just before things move against everyone else.
It looks suspicious, right? Yeah. What other patterns do they look for?
Yeah,
Patterns of trading around market-moving news that isn't public yet? That's a huge red flag.
definitely.
Also, repeated instances of someone taking an early position in a stock or bond, which is then followed quite quickly by large client orders in the same thing, or maybe the firm's own research report coming out on it. And finally, something more technical, access log anomalies. Records showing someone maybe viewed client order data they weren't authorized to see or shouldn't have needed to see. That points to potential misuse of information.
Those red flags seem pretty clear when you list them, but the source also mentions there are significant challenges for the surveillance systems trying to catch this. What makes spotting it so hard in practice? even with fancy tech.
The challenge is that the surveillance systems have to do more than just flag suspicious timing. That's part of it, but not enough.
Right.
They need to be sophisticated enough to correlate multiple different data points. You need the exact timestamps of trades and orders, yes, but also electronic communications, emails, chats between people.
Hmm.
And crucially, the systems or the analysts using them have to try and build a picture of the intent behind a trade. Was it legitimate market activity, or was it based on that prohibited advanced knowledge?
Ah, connecting the dots.
Exactly. It's connecting the dots between the timing, who knew what information, what they might have said about it, and what trades they actually did. And doing that often across just massive volumes of data. It's tough.
That connecting the dots challenge sounds really significant.
Mhm.
So, okay, what about prevention? How do you stop this from happening in the first place? What kind of robust measures should institutions have, according to the source?
Yeah, prevention is key. Financial institutions really need strong internal controls, clear policies, and the right technologies. The article lists several key practices.
Like what?
One absolutely critical measure is segregating proprietary trading desks. That's where the firm trades for its own profit.
Right.
Segregating those from the client trading desks, the ones handling customer orders.
Keeping the firm's own trading physically and functionally separate from client business. That makes a lot of sense. Just reducing the opportunity for that conflict of interest.
It's foundational, really. They also need to implement advanced trade surveillance tools. Tools specifically designed to automatically flag suspicious timing, weird order sequencing, or those unusually favorable price improvements we talked about.
Okay.
Restricting access to sensitive order information is also crucial. Really locking down who, particularly among sales teams or execution staff, can actually see the details of incoming client orders before they're executed.
Limiting who can even see that valuable, potentially market-moving information in the first place.
Exactly, information control. Maintaining electronic communication monitoring is also highlighted as essential. Systems that can scan emails and chats for keywords or discussions where order details might be improperly shared or hinted at.
Okay.
And the source really emphasizes regular compliance training, making sure everyone understands insider trading rules, market abuse regulations, and just basic ethical conduct. It has to be constantly reinforced.
Yeah, training seems fundamental, making sure everyone knows the rules and understands just how serious breaking them is.
It absolutely is. The article also highlights the importance of documenting the rationale and intent behind trades, especially for people in high-risk roles or those trading in markets known to be more susceptible.
Creates a clear audit trail.
Precisely. And finally, the critical role of internal audit teams and compliance officers is stressed. They are key players in reviewing any suspicious patterns flagged by the systems and deciding whether to escalate things into a full investigation.
So it's really a multi-layered defense.
Mhm.
Structural separation, technology watching the trades, access controls on information, monitoring communications, training people, documenting decisions, and then vigilant human oversight from compliance and audit.
That's a good summary of the source's points, yeah.
Okay, finally, let's talk about the broader impact.
Yeah.
Beyond the client who got directly harmed, why should, everyone else care about front running? The source details this too.
It does. The source explains there are definite ripple effects. Beyond the immediate client getting a worse price, front running fundamentally undermines things like market fairness, transparency, and overall investor confidence.
It kind of shakes the very foundation of a market that's supposed to be, well, fair for everyone participating.
Precisely. It distorts price discovery. That's the whole process where supply and demand are supposed to figure out the true value of something. Front running messes that up by introducing artificial demand or supply based on secret information.
Right.
It also erodes trust in the intermediaries,
Hmm.
the brokers, the banks, the firms that people rely on to handle their trades, honestly.
Yeah.
And ultimately, it just creates an uneven playing field. It
Yeah.
means those with inside knowledge have an unfair and often illegal advantage over the vast majority of market participants.
And for the bigger players, like asset managers or institutional investors, the ones placing those large orders that get front run, what's the impact on them?
Well, for them, front running by their brokers or maybe counterparties can lead directly to execution slippage, basically. They get a worse price than they should have.
Okay.
It means higher transaction costs overall. And it can even expose their trading strategy prematurely if their large orders are consistently being detected and traded against before they're fully executed.
Ah, so it could reveal their hand strategically.
It can. So the source concludes by really emphasizing that tackling this risk isn't just about ticking regulatory boxes. It's essential for maintaining basic ethical standards and protecting the overall integrity of financial markets for everyone.
Well, this deep dive into the source material has really shown us what front running is, the sometimes quite sophisticated ways it happens, why it's so strictly illegal, how it's being policed through detection and surveillance, and the extensive preventative measures firms really should have in place. Understanding this complex issue, I think, helps you see some of the critical mechanisms at play affecting how fair and trustworthy our financial markets actually are.
Absolutely. And maybe just to leave you with something to think about, connecting back to that speed and complexity, especially with electronic trading and algorithms that the source mentioned, it raises an important question.
Okay.
Given all that technological change, what does this ongoing fight against front running really tell us about the evolving nature of financial crime itself? And maybe more importantly, what does it tell us about the huge challenges involved in trying to keep these incredibly fast, complex markets truly fair and transparent for absolutely everyone involved?